Traders walk into the market with a belief that feels completely logical. If you want to make big money, you need to place big trades. The idea sounds powerful, confident, even ambitious. After all, if you risk more, you can earn more, right? This belief spreads quickly through trading communities, social media, online forums where screenshots of massive profits make aggressive trading look exciting and heroic. Hidden beneath this idea is one of the most dangerous lies in the entire trading world. A lie that quietly destroys more trading accounts than bad strategies, poor indicators, or even market crashes. And the most painful part is that many traders don't realize it until their account balance has already collapsed. Think about this for a moment. Two traders begin on the same day with the same amount of capital. One trader decides to grow the account quickly by risking large portions on every trade. The other trader risks only a very small amount each time. At first glance, the aggressive trader looks smarter, braver, and more confident. Their profits appear bigger when a trade works, move faster, the excitement is higher. Something unexpected begins to happen over time. The aggressive trader starts experiencing massive swings. Loss wipes out several previous wins. A bad day turns into a devastating week. Meanwhile, the cautious trader grows slowly, almost quietly, without dramatic gains or catastrophic losses. Is the moment where many people feel confused. If the goal of trading is to make money, why would professional traders risk so little? Why would hedge funds, institutions, and experienced market veterans often risk only 1% or even less on a single trade? Why do the traders who survive the longest appear to be the most conservative with their risk? To answer that question, we need to understand something about human psychology. The human brain is naturally drawn to speed and reward. In everyday life, taught that more effort leads to bigger outcomes. Work longer hours, earn more money. Lift heavier weights, gain more strength. Take bigger opportunities, achieve bigger success. This cause and effect mindset works in many areas of life. So when people enter the financial markets, they carry the same belief with them. Bigger trades should mean bigger profits. Risk should create faster success. But financial markets don't operate according to that simple rule. Markets are unpredictable environments filled with uncertainty, randomness, powerful forces that no single trader can control. Prices move because of millions of decisions happening simultaneously across the world. Institutions, algorithms, hedge funds, banks, and retail traders all interacting at the same time. In this environment, confidence alone does not create profits. Courage does not guarantee success. Aggression does not produce consistency. Instead, markets reward something much less exciting, but far more powerful: discipline. Discipline means protecting capital before chasing profit. Discipline means accepting small losses without emotional reactions. Discipline means understanding that trading is not about being right every time. It is about staying alive long enough for probability to work in your favor. Unfortunately, most traders never learn this lesson early enough. When beginners enter the market, their attention immediately goes towards strategies. They search for the perfect indicator combination. They watch videos promising secret entry signals. They study chart patterns and resistance, trend lines, and price action techniques. All of these tools can be useful, but they are not the foundation of long-term success. In fact, many traders can have a profitable strategy and still lose all their money simply because they ignore the one skill that matters most. That skill is risk management. Management is the quiet backbone of every successful trading career. It determines how much you lose when you are wrong, how long you can stay in the game, and whether your account survives long enough to benefit from your winning trades. Without proper risk management, even a strategy that wins more than half the time can eventually destroy a trading account. Imagine a trader who risks 20 or 30% of their account on every trade. At first, they might experience a few wins that make them feel unstoppable. Their account balance rises quickly, reinforcing the belief that aggressive trading works. Then the market does what it always does. It delivers a series of losses. Maybe 3 trades fail in a row, maybe 5. Suddenly, the account drops dramatically, and recovering from that loss becomes almost impossible. This is where the harsh reality of trading appears. Losing half of your account doesn't mean you only need 50% to recover. Actually need 100% just to return to where you started. Lose 70% and the required recovery becomes more than 300%. The deeper the loss, the harder it becomes to climb back out. Mathematical trap is where thousands of traders disappear every year. They were not defeated by a bad strategy. They were not defeated by the market itself. They were defeated by the speed at which they risked their capital. Professional traders understand this danger deeply. Their goal is not to win every trade. Their goal is survival. They know that the market will always produce losing streaks, unexpected news events, and unpredictable price movements. Instead of trying to eliminate risk completely, control it carefully. By risking very small amounts per trade, they ensure that no single mistake can destroy their account. This mindset changes everything. When risk is small, fear becomes smaller. When fear becomes smaller, decisions become clearer. Traders stop chasing the market emotionally and start following structured plans. They focus less on dramatic wins and more on steady progress. Over hundreds of trades, that steady progress begins to compound into something powerful. Trading success rarely comes from one spectacular trade. It comes from thousands of small decisions made with patience and consistency. And this is the core idea that separates struggling traders from professionals. The traders who ultimately make the most money are often the ones risking the least on each individual trade. They understand that trading is not a sprint where speed determines the winner. It is a long journey where survival determines who remains in the game. Every trade is only one moment inside a much larger sequence. Hundreds of trades will occur over time. Thousands of decisions will shape the final result. Trader who protects capital during losing periods is the one who can fully benefit when favorable conditions return. But to truly understand why small risk leads to long-term profitability, we must look deeper into something many traders never study: the hidden mathematics of losses. Once you see how losses actually affect your account, you will understand why professional traders protect their risk with extreme precision. If there is one truth about trading that many beginners struggle to accept, it is this: is not a mistake in trading, it is a built-in part of the game. Every trader loses. Every strategy loses. Even the most experienced professionals in the world go through periods where multiple trades fail one after another. This isn't a sign that something is broken. It is simply the natural rhythm of probability playing out in the market. Many people enter trading believing that success means predicting the market correctly most of the time. They imagine professional traders sitting in front of charts with near-perfect accuracy, catching winning moves again and again while rarely experiencing losses. The reality is very different. Profitable trading systems actually operate with a win rate somewhere between 40 and 60%. That means that out of every 10 trades, 4, 5, or even 6 might lose. For a new trader, it can feel shocking. If nearly half the trades are losses, how can anyone possibly make money? The answer lies in how those losses are controlled and how the winning trades are managed. Before understanding profits, it's important to understand the brutal mathematics of losing streaks. Because losing streaks are inevitable. Even a strategy with a 50% win rate will regularly produce sequences where several trades fail in a row. 4 losses back-to-back is common. Losses can happen without anything being wrong with the strategy. In some cases, traders may even experience 6 or 7 losing trades consecutively. To a beginner, panic often follows. They assume the strategy stopped working or that the market suddenly changed. In reality, probability simply produced a temporary cluster of losses. Now, here is where risk management becomes the deciding factor between survival and disaster. Imagine 2 traders using exactly the same strategy. They enter the same trades at the same prices with the same stop losses and targets. The only difference between them is how much they risk on each trade. Trader A decides to risk 10% of their account every time they place a trade. The logic feels appealing. If the trade wins, the profit will be significant. Growth will be fast. The account could double quickly if several trades succeed in a row. Trader B takes a completely different approach. Instead of chasing rapid growth, trader risks only 1% of the account per trade. The gains appear much smaller at first glance. Progress feels slower, even seem conservative or overly cautious compared to the bold strategy of trader A. Then, the market produces something perfectly normal. 5 losing trades in a row. For trader A, damage becomes severe. Losing 10% 5 times in succession doesn't just reduce the account slightly. It cuts deeply into the balance, creating a massive drawdown that shakes confidence and emotional stability. Suddenly, every new trade feels frightening. Doubt begins to replace discipline. Trader who once felt confident now starts questioning every decision. Trader B experiences the exact same losing streak, but the outcome looks completely different. Each trade risked only 1%. The total damage remains relatively small. The account dips slightly, but nothing catastrophic occurs. Confidence remains intact. Strategy continues operating exactly as planned. This comparison reveals something extremely important about trading. Both traders use the same strategy and face the same market conditions, experience the same losing streak, yet their results are completely different. The difference is not intelligence. It is not skill, not even strategy. The difference is position size. Position sizing determines how much damage a single mistake can cause. When the risk per trade is large, normal losing streaks become destructive events. When the risk is small, same losing streaks become manageable fluctuations within a larger trading journey. But the real danger appears when we examine the mathematics of recovery. Many traders believe that if they lose a certain percentage of their account, they simply need to make the same percentage to recover. Unfortunately, trading mathematics does not work that way. A trader loses 10% of their account, they actually need approximately 11% profit to return to the starting balance. That difference may seem small at first, it grows dramatically as losses increase. If the account loses 30%, the required recovery jumps to roughly 43% just to break even. The situation becomes far worse when losses grow deeper. A trader who loses half of their account must achieve a 100% gain just to return to the original balance. Think about that for a moment. After a 50% loss, a trader must double their remaining money simply to recover what was lost. This is the brutal mathematical trap created by large position sizes. The deeper the drawdown becomes, steeper the climb back to stability. Many traders find themselves stuck in this recovery cycle, taking increasingly risky trades in an attempt to rebuild their account faster. Ironically, desperation often leads to even larger losses. Small risk prevents this cycle from forming in the first place. When each loss is controlled, the account avoids large drawdowns. Recovery becomes easier and faster because the trader never falls into the deep mathematical hole created by aggressive trading. The account moves forward slowly but consistently, avoiding the destructive swings that eliminate so many traders. However, the damage caused by large losses goes beyond simple mathematics. Money can sometimes be recovered. Confidence is much harder to rebuild. After a severe drawdown, traders often begin doubting their strategy. They hesitate before entering trades that previously followed their plan. Fear begins to interfere with decision-making. Traders become overly cautious, skipping good opportunities. Others swing to the opposite extreme, taking reckless trades in an emotional attempt to recover quickly. This leads to an important realization. Large losses do not just destroy capital, they destroy emotional stability. And emotional instability is one of the most dangerous conditions a trader can face. Because once fear, frustration, and desperation begin influencing decisions, best trading strategy can collapse. Discipline disappears, rules are ignored, risk increases at the worst possible moments. That is why professional traders treat risk management as the foundation of their entire trading process. They understand that protecting the account from large drawdowns protects something even more valuable: their ability to think clearly and act rationally in the market. The most dangerous impact of oversized trades is not purely mathematical, and it is not purely financial. The real damage happens inside the trader's mind. Trading is often described as a technical skill, something built on charts, strategies, indicators, and market analysis. But once real money enters the equation, trading quickly becomes something much deeper, a psychological battle. And nothing intensifies that battle more than risking too much money on a single trade. Traders place large trades relative to their account size. Every tiny movement in price suddenly feels enormous. A small fluctuation that would normally be insignificant begins to look like a serious threat. The trader starts watching the chart constantly, sometimes every few seconds, waiting for the price to move in their favor. Instead of calmly following a strategy, they become emotionally tied to every tick of the market. This is where stress begins to replace logic. Too much money is on the line. Trading stops feeling like a structured decision-making process. It starts to feel like gambling with high stakes. Heart rate increases. Focus narrows. Instead of analyzing the market objectively, the trader begins reacting emotionally to every movement. If the price moves slightly against them, fear appears almost immediately. Start racing. What if this trade keeps going against me? What if I lose a large portion of my account? The trader may move their stop loss farther away, hoping to avoid the loss. They may close the trade too early out of panic, even if the strategy says to hold. But the emotional roller coaster does not only happen during losing trades. Winning trades can create an equally dangerous psychological effect. When a trader wins a large trade, especially one that generates significant profit in a short time, the brain responds with a powerful chemical reaction. It releases dopamine, the same neurotransmitter associated with excitement, reward, and pleasure. This surge of dopamine creates a strong emotional high. The trader feels successful and confident. For a brief moment, the trader may feel unstoppable. Thoughts like, "finally figured it out," begin to appear. Confidence grows rapidly, sometimes faster than experience can support. Trader starts believing that their recent success proves they have mastered the market. This is where a subtle psychological trap begins forming, because the brain wants to repeat the feeling of that big win. Just like any other reward-driven behavior, the brain begins seeking another surge of dopamine. Trader wants to experience that excitement again. The easiest way to chase that feeling is by increasing risk. Larger trades promise larger profits. Profits promise an even bigger emotional reward. So the trader increases position size. Perhaps the first large win came from risking 5% of the account. The next trade risks 8%, 10%. The trader may not even notice how quickly the risk is growing because the excitement of winning creates a false sense of control. For a short period of time, cycle can feel incredibly powerful. But markets eventually deliver something every trader must face: a loss. And psychologically, losses affect the brain far more strongly than wins. Behavioral science has shown that the emotional pain of losing money is often 2 times stronger than the pleasure of gaining the same amount. In other words, losing one hurts far more than winning dozens and thousands feels good. When a trader experiences a large loss after increasing their position size, the emotional impact can be overwhelming. The excitement that previously fueled confidence suddenly turns into frustration and shock. The trader may stare at the screen wondering how the market moved against them so quickly. Another dangerous emotion appears: urgency. The trader begins feeling pressure to recover the loss as fast as possible. Instead of accepting the loss as part of the trading process, the mind starts searching for a way to fix the damage immediately. This is where one of the most destructive behaviors in trading begins: revenge trading. Trading happens when a trader stops following their strategy and begins making impulsive decisions driven by emotion. The goal is no longer to trade well. The goal becomes recovering the lost money as quickly as possible. The trader might increase trade size even further, believing a single winning trade can erase the previous loss. They may start entering trades without proper analysis, jumping into the market the moment they see a small movement. Setup quality no longer matters. Strategy rules are ignored, disappears completely. Every trade becomes a desperate attempt to repair the previous mistake. Unfortunately, this behavior almost always leads to even bigger losses. The market rarely rewards emotional decisions. When traders abandon discipline, they often enter poor setups at the wrong time. The larger position sizes amplify every mistake, turning small errors into major damage. At this point, the trader can fall into what many professionals call a trading death spiral. It starts with a loss. Loss triggers panic and emotional stress. The trader responds by taking a bigger trade. The bigger trade leads to an even larger loss. Larger loss creates even stronger emotional pressure. The cycle continues repeating, each step becoming more destructive than the last. Loss leads to panic. Panic leads to impulsive trading. Impulsive trading leads to even bigger losses. For many traders, this spiral happens quickly. Began as a single bad trade can turn into a devastating account collapse within hours or days. Looking back afterward, trader often realizes that the biggest damage did not come from the market itself. It came from the emotional reactions that followed the initial loss. This is precisely why experienced traders focus so heavily on controlling risk. When the risk per trade is small, emotional intensity decreases dramatically. Losing trade becomes a manageable event rather than a psychological crisis. The trader can accept the loss, record it in their journal, and calmly move on to the next opportunity. Small risk protects more than the trading account. It protects the trader's mental clarity. Without overwhelming fear or pressure, traders can follow their strategy with discipline. They can think objectively, analyze setups properly, and maintain consistency over long periods of time. And most importantly, avoid entering the destructive spiral that wipes out so many trading accounts. But avoiding the psychological trap of large trades is only part of the equation. Traders who truly succeed in the long run follow a very different philosophy, one that turns small, controlled risks into powerful long-term growth. If you observe how experienced traders operate, you'll notice something that surprises many beginners. Professionals who manage large accounts and trade for years rarely behave the way new traders imagine. They are not constantly chasing massive trades or trying to double their accounts in a few weeks. In fact, professional traders appear almost conservative compared to the aggressive style seen among beginners. The reason is simple. Their primary goal is not quick profit. Primary goal is longevity. Professional traders understand that trading is not a short-term challenge. It is a long-term career that unfolds over thousands of trades and many years of market cycles. Markets rise and fall. Volatility increases and disappears. Economic conditions change. Strategies go through periods of strong performance and periods of difficulty. Trader who survives through these changes is the one who ultimately benefits from the opportunities the market provides over time. Because of this, experienced traders view risk very differently from beginners. A beginner often asks, "How much money can I make from this trade?" A professional asks a completely different question. "How much can I lose if this trade fails?" This shift in perspective changes the entire approach to trading. Instead of focusing only on profit potential, professionals focus on protecting their capital first. They understand that opportunities in the market will always return. But once trading capital disappears, the game is over. To protect that capital, most experienced traders follow a simple but powerful rule. They risk a very small percentage of their account on each trade. Typically falls somewhere between 0.5% and 2% per trade. In many cases, institutional traders operate even closer to the lower end of that range. At first glance, this may seem surprisingly small. Many beginners believe that risking such a tiny amount would make it impossible to grow an account meaningfully. The real power of this approach becomes clear when you consider how it affects both financial stability and psychological control. When risk per trade is small, the account becomes extremely resilient. Losing trades no longer threaten the survival of the account. Even a series of losses only creates a modest drawdown rather than catastrophic damage. Trader remains stable and capable of continuing their strategy without disruption. Imagine experiencing 5 losing trades in a row while risking 1% per trade. The account would decline slightly, but the impact would remain manageable. Now imagine the same losing streak while risking 10% per trade. The account would suffer a massive decline, forcing the trader into a stressful and difficult recovery situation. This is why professionals prioritize small risk. They know that losing streaks are inevitable. Instead of trying to avoid losses entirely, they design their trading approach so that losses remain controlled and manageable. The goal is not to eliminate risk. The goal is to keep risk small enough that it never becomes destructive. But the advantages of small risk go far beyond protecting the account balance. Risk also transforms the trader's emotional experience. When a trader risks too much money, every trade becomes emotionally intense. Fear appears quickly when the market moves against them. Excitement can become overwhelming when the trade moves in their favor. These emotional reactions interfere with rational decision-making. However, when the risk is small, the emotional pressure decreases dramatically. Trader can remain calm while the trade develops. They can allow the strategy to play out naturally instead of interfering with emotional decisions. If the trade loses, it becomes a normal part of the trading process rather than a painful event. This emotional stability improves nearly every part of the trading process. Entries become more precise because the trader is not rushing into the market out of fear of missing out. Exits become more disciplined because the trader is not closing positions early due to anxiety. Stop losses are respected rather than moved in desperation. Over time, calm and structured approach produces something extremely valuable: consistency. Consistency is the hidden engine of long-term trading success. It allows traders to measure the true performance of their strategy, refine their process, and steadily improve their decision-making. Without consistency, it becomes impossible to distinguish between strategy performance and emotional mistakes. Small risk also provides another powerful advantage that many beginners overlook. It increases survival during extreme market conditions. Financial markets are not always stable. At times they experience dramatic crashes, sudden spikes in volatility, unexpected price movements triggered by economic news or global events. These moments can be extremely dangerous for traders who are heavily exposed to the market. Aggressive traders often suffer severe damage during these periods because their position sizes are large. Sudden price movements can wipe out large portions of their accounts in a very short time. Some traders are forced out of the market entirely after a single extreme event. Conservative traders experience these same market events very differently. Because their risk per trade is small, unexpected volatility becomes manageable rather than catastrophic. Their accounts may experience temporary losses, but they remain intact and capable of continuing to trade. Instead of being eliminated from the market, they remain active participants. Survival advantage becomes incredibly important over the long term. Markets eventually recover from crashes. Volatility eventually stabilizes. New opportunities always appear. The traders who survive the difficult periods are the ones positioned to benefit when conditions improve again. In other words, survival creates opportunity. Aggressive traders often disappear during the most difficult market phases. Conservative traders remain present, prepared, and financially stable enough to take advantage of the next wave of market movement. And this is where the real power of disciplined trading begins to reveal itself. A trader combines small risk with patience and consistency. Something remarkable starts to happen inside the trading account. Growth begins to compound. True power of trading is rarely found in a single spectacular win or a risky trade that doubles an account overnight. Instead, it lies in the quiet, patient, and disciplined process of making small, consistent profits over time. This is the principle of compounding, a concept that transforms steady, manageable gains into exponential wealth when applied over months and years. Consider a trader who earns just 4 to 6% per month. At first glance, this may seem modest, even underwhelming. Yet, when these profits are compounded, the results are extraordinary. Each month's gain adds not only to the original account balance, but also to the profits already earned. Over a year, steady growth can double the account. Over several years, the compounding effect can turn a small account into a substantial trading portfolio. The key is that these profits are consistent. The trader avoids massive drawdowns and survives through both good periods and bad. This is in stark contrast to the aggressive trader who constantly seeks rapid growth. Aggressive traders often chase large profits with oversized trades only to face devastating losses that wipe out months or even years of gains. When a big loss occurs, the account must recover before growth can continue. Many traders blow up repeatedly, restarting their journey over and over. The volatility of their results may be dramatic. Long-term wealth often remains stagnant or worse, disappears entirely. Conservative traders, on the other hand, experience a very different trajectory. Risking small amounts consistently, they remain in the market even during the most challenging conditions. Their accounts continue to grow slowly but steadily, unaffected by emotional panic or catastrophic drawdowns. Over time, this approach produces a compounding effect that far exceeds the flashy risk strategies attempted by many beginners. The key to this process is a mindset shift. Successful trading is less about chasing immediate gains and more about protecting capital, so that growth can continue uninterrupted. Often ask, how much can I make on this trade? Professionals ask a very different question. How much can I protect? By prioritizing capital preservation, traders create a foundation for sustained success. Each trade becomes a small, controlled step forward, rather than a gamble that could end the journey prematurely. Mindset changes everything about how traders approach the market. Entries and exits are chosen carefully. Risk is measured and controlled. Emotional reactions are minimized. Traders focus on long-term consistency rather than short-term excitement. Over months and years, small advantages compound into significant wealth. Perhaps the most powerful lesson from long-term trading is that survival is the ultimate edge. Markets are unpredictable, and no trader can win every trade. Strategies that work well today may falter tomorrow. Global events, sudden volatility, and unexpected economic shifts can all impact results. Yet the trader who survives these events, who protects capital and remains disciplined, is the trader who ultimately benefits when opportunities arise. It's easy to underestimate the value of patience in trading. Watching profits grow slowly can feel boring compared to the adrenaline rush of high-risk trades. The reality is that patience and discipline are what separates successful traders from failed ones. While aggressive traders may experience dramatic highs and crushing lows, the steady, controlled trader steadily climbs toward their goals. At its core, trading is not a sprint. It is a long-term game, a journey measured in years, not weeks or days. The traders who dominate the market are rarely those who take the biggest risks. They are those who master the art of small, consistent growth. They understand that compounding works best when losses are minimized and strategies are followed with discipline. The final message is clear. The difference between a successful trader and a failed one is not intelligence, strategy, or market knowledge alone. It is risk control. Traders who survive the longest, who protect their capital through disciplined decision-making, often end up winning the biggest. They understand that trading is not about the thrill of a single trade, about being present for hundreds, thousands, or even tens of thousands of trades over a lifetime. In the long run, a trader who risks small and thinks strategically about capital preservation does more than just survive. They grow, compound, ultimately achieve the kind of wealth and consistency that aggressive traders can only dream of. Trading is a game of patience, discipline, and survival. And in that game, small, consistent growth is the true path to victory. The ultimate truth of trading is this: those who protect their account first are the ones who allow profits to flourish naturally. Small, stay consistent, survive, and let compounding do the work over time. This quiet, disciplined approach outperforms the reckless chase for instant wealth every single time. A trader who follows this path may not experience explosive short-term gains, but in the end, they are the ones who truly win the trading game.